Hello friends, welcome to learning sessions and today it's the second session for the capital budgeting for international projects investment decision, and we are going to learn from the first topic that's about the foreign currency approach. We have already covered the topic related to the home currency approach in the previous session, and now we are going to start with the foreign currency approach. So if you remember, I told you a structure like in case of the home currency approach, what steps are to be followed, and in case of the foreign currency approach, what steps are to be followed. So if you do memorize, do let me know at the earliest. Just do confirm that if you remember that what approach was there in case of the foreign currency. In case of the foreign currency approach, what method was used? Like the cash flows of the main project remain in the foreign currency only, and they are not converted into the home currency. First of all, that's what I just told you, right? So let's say you are having the cash flow, so you'll be estimating the cash flows, and that will be, they will be remaining in the foreign currency only, no change. And then you'll be using the discount rate so as to calculate the present value. Then you'll be converting them into the home currency. So this is a process which has to be followed in case of the foreign currency approach. In case of the foreign currency approach, this particular method was to be followed. Clear with it, right? So let's go ahead with the foreign currency approach here. So let's have a look at the example here. So it says that the cash flows of the project are as under: initial investment, first year net cash flow, second year net cash flow, third year net cash flow, fourth year net cash flow, the risk-free discount rate USA, the risk-free discount rate in India, risk-adjusted rate, that is RA, is given right in India, and the current spot rate S is given to be rupees 80. So this particular amount is given to you, and you have to calculate the. We are basically supposed to calculate the PV of the cash inflows of the project, which has useful life of 4 years, using the foreign currency approach. So the step one would be related to what? That we have to determine the foreign currency risk adjusted discount rate. So we are provided the RA for the India. R in India is given, and the RF in US is given, the RF in India is given. So we are to calculate what? We are to calculate the risk free risk adjusted rate. Risk adjusted rate. What is the formula? What was the formula? I just already told you. The formula was quite simple. For the risk adjustment formula, what was the formula? We have already covered that particular part in yesterday video for the home currency approach. We have already covered that. It's 1 plus RA is equal to 1 plus RF plus 1 plus RP, right? So the risk premium for one country is available with us. The risk adjusted rate for one country is available with us, and based upon that we'll be calculating for the other one. So, but for the foreign currency approach, we are to use the international Fisher effect. We are to use the international Fisher effect. And what is the formula? So it will be 1 plus RAF. I'm writing why RAF? Because it's foreign currency risk adjusted rate that we have to calculate, and is equal to 1 plus RH. That's basically the domestic country risk adjusted rate. 1 plus RH, or you can simply be writing the RA here also. 1 plus RA, that's a domestic country risk adjusted rate, that is given to be 12% for us, and further divided by 1 plus RF, 1 plus RF, and 1 plus RF basically for domestic free rate, like risk free rate we are talking about. Okay, and further 1 plus RF, and further we are talking about this for the foreign country. So we are writing FF over here. So let me just put the values. You'll be understanding that what I'm trying to say. So first of all, we have to calculate the 1 plus RAF. That's the risk adjusted rate for the foreign country, right? And for the 1 plus RA, the numerator, it is RA for the domestic country we're talking about. This is given to be 12%. So it is 1.12 divided by risk-free rate. Risk-free rate in India is given to be 7%. It is 1.07 and multiplied by 1 plus RFF. That is a risk-free rate in USA. That is 4%. That is 1.04. So easily you can be calculating the risk-adjusted rate in USA. This is a Fisher effect formula. And for the what will be the answer? We can be using the simple calculator in the exam that's allowed. So answer will be 1.12 divided by 1.07 multiplied by 1.04. That's 1.088. 1.088. And further, when we'll be subtracting 1 from it, it will be 0.088. And when we'll be converting into the percentage, it will be 8.85%. It comes out to be 8.85%. That's the foreign currency risk adjusted discount rate. Now, once we have basically calculated this particular rate, we have to discount the cash flows in US dollar. We have to discount them. Like whatsoever the values that we are having over here, we have to discount these values to the current year, right? And for the what rate is to be applied, this particular risk adjusted rate is to be applied for discounting purposes. So what is the discounting factor formula? I've already told you. So it is 1 divided by 1 plus R raised to power n. So for the first year, it will be equal to 1 divided by 1 plus 0.088%. 1 plus 0.885% raised to power 1. Right? This way we can be calculating the present value factor. 1 divided by 1.0885. That is 0.919. 0.919. So then we'll be multiplying this discounting factor. So this is a discounting factor that we calculated for the first year. Same way we have to calculate it for the second year, third year and all. And this is 0.919. When we are solving it, we are getting 0.919. And we'll be getting the another one for the next year. It will be 0.844. So the trick is like when you'll be calculating this particular formula for the first time on your simple calculator, simply just press the equal to sign and you'll be getting it for second year. And then you'll be pressing it again. You'll be getting it for third year, equal to sign again. And pressing the equal to sign again, we are getting it for the fourth year. That is 0.712. Right? So these are the values that we are getting. Now, once we have calculated, we have to multiply the values and we'll be getting the present value of the cash flows. But remember this in USD only. These are in USD only right now. We have not converted into the home currency. So it is 0.919 into 30. That's basically makes it 27.57. That's a present value that we have calculated, right? The second one, it is 40 into 0.844. That is 33.76. The third one, it is 50 into 0.775. That is 38.75. And the fourth one, it's 50 into 0.712. That is 35.6. So these are the values that we are having now. These are the value we are having now. We will be adding them up all and we'll be getting what? We'll be getting the total present value in US dollar. So 27.57 plus 33.76 plus 38.75 plus 35.6. That is coming out to be 135.68. 135.68. This is a value in USD that you're getting, the present value in USD. Now the next step is just one step. That's basically converting the USD to INR, and that is to be done at the present spot rate, right? That is to be done at current spot rate. So it will be like 135.68 multiplied by 80, and that comes out to be 108,544. 108,544. Right? That's a present value in Indian rupee. That's a present value in Indian rupee. Now, if it were related to the home currency approach, like this we calculated for the foreign currency approach, but if the same question was there for the home currency approach, when we estimated the net cash flows, after that we are to multiply it with the spot rate, the estimated spot rate. So for the home currency approach, we are to estimate the, for the home currency approach, we have to do what? We have to estimate the spot rates. We have to estimate the spot rate. And there this particular formula would be applicable. When you are going to estimate the spot rate, this particular formula will be applied. That is ST is equal to S0 multiplied by 1 plus RF divided by 1 plus RP raised to power n. So ST is expected future spot rate. Let's suppose we are to calculate the spot rate after 1 year. We have to estimate the spot rate after 1 year. So we will be looking at the current spot rate. So it was 80 rupees as per the above question we are talking about. And RF is basically the foreign inflation rate or the foreign interest rate, the risk-free rate. That is 1 plus RF. That was 4%, I guess. So that is 1.04. 1.04. Let me just look at it. It is 4%, yes. And 1 plus RP. 1 plus RP, the risk adjusted rate for the foreign currency, that is given to be 8.85%. So it is 1.0885 and raised to power 1. This is will be for the first year. And for the second year, it will be 2, then 3, and so on. Right? So you can be estimating the spot rate for the different years. Right? So you will be doing what? In that particular scenario, whatsoever the foreign currency cash flow is there, that is to be converted into the Indian rupee, multiplying it with the estimated spot rate. You'll be having the INRs with you. And once you are having the INRs with you, then you are to do the discounting upon it. That's a foreign currency approach, home currency approach. That's a home currency approach. So for the payback period method, that's the first method that we're going to cover. That's a payback period method. In this case particularly, we have to estimate the future spot rates. We do estimate the future spot rates, right? And then we do convert the foreign currency cash flows into the home currency. And then we have to convert the current investments into the home currency by multiplying it with the present spot rate. And the fourth would be related to, we have to look at the time period during which the cash inflows will be covering the initial investment. So here is a like question given to us. Now we have already covered one step. Like we have already converted the foreign currency cash flows to the Indian rupee. This is already converted one. So we are not to do the step number 1 and 2. Step number 1 and 2 and 3 not to be done. So the payback period would be related to what? It will be equal to what? It will be equal to like we are having the total investment of rupees 8,000 lakh. So the initial one is 2469. So 2469 for the first year. For the second year, it is 3387. For the third year, this is this one. So it is like 2469 plus 3387 plus 4356. When we are adding these three, the total amount is coming out to be 10,212, which is basically greater than 8,000. So we have to basically find out at the point of 8,000 only. So 2469 plus 3387, the first two, the total is 5856. It is 5856, right? So the left amount is 8,000 minus 5856, that is 2144. The 2144 is left. So the 2144 out of the 4356 is to be used. So we'll be getting it as a fraction plus 2. So it is 2144 divided by 4356 and for the plus 2. So the payback period is 2.492. 2.492. The calculation is not done right way here. I think there is some problem with the calculation. So look at it. So the calculation will be 2.492. Getting it? So that's the payback year calculation. So we can say it's almost 2 years and 6 months. 492 means 6 months. Okay. So that's 2.492. And the same way when we have to calculate the NPV, we are talking about the home currency approach. So you must be having the basics with you, that what the home currency approach means. In case of the home currency approach, the point that is to be kept in mind, that's like we are to convert the estimated cash flows into the home currency, right? And that can be done how? Like whatsoever the cash flow you are having, you will be multiplying with the estimated spot rate, and you'll be having the Indian rupee amount. And then after that, you are to discount these values. Getting it? No. It's about the NPV method. The step one would be related to, we have to estimate the spot rate. That's the same method, same point, right? The step two will be related to, we have to convert the foreign currency cash inflows into the home currency inflows. And then we have to convert the initial investment into the home currency by using the actual present spot rate. The initial investment in foreign currency into home currency by using the actual present spot rate, right? And then we have to discount the cash inflows using the domestic risk adjusted rate. Now here you'll be using the domestic risk adjusted rate for discounting purposes, and we are to calculate the present value of the cash flows. Getting it? We are having the risk-free rate for the domestic currency. We are having the risk adjusted rate for the domestic country. Now here we'll be using the RA for the domestic country. Okay, then we'll be calculating the NPV by subtracting the initial investment. Like the same method that we used for the NPV in the previous chapter, that is to be used, but after dealing up with this mess. Getting it? So the question says that in above question, the PV of the cash flow in home currency is calculated to be 10,852 lakh. So we calculated the present value here, 10,852 lakh. NPV would be equal to what? NPV would be equal to 10,852 minus 8,000, that is 2,852 lakh. Now, would you be undertaking this particular project? Would we be undertaking this project? Yes or no? Should we be undertaking? What was the decision-making process related to the NPV? The process was very simple. Like if you are having NPV positive, then yes. If negative, then no. If zero, indifferent. Then it was indifferent. Right? Getting it? And how we have to solve it? Very easy. So NPV is what? NPV is the net present value. That's basically is the algebraic sum of all the cash flows, discounted cash flows. Okay. Then it's the IRR. IRR. IRR is the discount rate at which the NPV becomes zero. IRR is the discount rate. So if IRR is greater than the cost of capital, do undertake the project. If IRR is lower than the cost of capital, leave the project. If IRR is equal to the cost of capital, it's upon you if you want to undertake the project or not. And if we are dealing with the mutually exclusive projects, then the project with the highest IRR is to be selected. Same things are to be done. We have to estimate the spot rate for each year. We have to convert the cash currency inflows into home currency. We have to convert the initial investment in home currency, like by using the actual present spot rate. And then we are to basically discount them, right? We have to discount them, but by hit and trial error method. By trial and error method, like we did in the previous chapter, that we are to estimate, we have to basically assume two rates, two discount rates are to be assumed, right? Two discount rates are assumed, and then we do calculate the IRR using the formula, and then we are done. Okay, so here the initial investment is given, the first year inflow, second year, third year, fourth year inflows are given, and further we have already now converted them into the Indian rupee. We have already converted them into the Indian rupee. Otherwise, you have to do these steps also. Let's say it is given like you are having the 10 lakh of the USDs as the inflow, 10 lakh USD as the inflow. Then first of all, we are to estimate the spot rate. The first thing that we have to estimate the spot rate using this particular formula that we covered above also. Using this formula, you'll be converted them into the INR, and after that you are going to discount them. And discounting is to be done by hit and trial and error method. By trial and error method we are to do. So it will be like assuming the parts, and that would be it. So what is the equation here? Let me just re-elaborate the equation here. So it's like initial investment, NPV is equal to 0. Initial investment is negative, like there is a negative sign. And for the whatsoever the amount that you're getting, there's a cash flow. So it is 2469 divided by 1 plus IRR. 1 plus IRR plus the second one, it is 3387 divided by 1 plus IRR raised to power 2, and the third one, it's 4356 divided by 1 plus IRR raised to power 3, right? So here is the equation, and using this equation we have to solve it, and we'll be getting our answer. Like in this case, they are saying they estimated about it, and it came out to be 27%. Okay, so let's say if the cost of capital was 15%, let's just assume if the cost of capital is equal to 15%, would you be undertaking this project? Do answer yes or no. Would you be undertaking this project? Yes, definitely. Because it's like you're having the, you're basically having the cost of capital lower than that of the IRR, then you'll be undertaking the project. That's the rule. That's the complete rule. Okay. So now let's move ahead. It's about the profitability index method. Now, what is the formula for the profitability index? Like the present value of cash inflows. So present value of cash inflows divided by initial investment. Divided by initial investment. That's your PI. So here also, like we are to do the follow steps number 1, 2, 3, and 4. Discounting is to be done, and then we'll be calculating the PV. Like for this case, we are provided with the initial investment of 8,000 lakh as per the previous questions, and for the we calculated the present value of the cash inflows to be 10,852. So what will be PI? It is the formula like PV of the cash inflows, that is 10,852 divided by 8,000. So it is coming out to 1.356. So the profitability index is 1.356. Right so far? Do confirm at the earliest. And then it's about the evaluation methods, foreign currency approach. Now only what things are changing here? What particular points are changing? It's just about the calculation method. It's just about the method. So in case of the foreign currency approach, what method is to be used? Like whatsoever your cash inflows are there, cash flows are there, those are to be kept in foreign currency only. Discounting is to be done in foreign currency only. You'll be having the present value in foreign currency only, right? So far we are having the foreign currency present value, right? And then you will be converting into the home currency using the current spot rate. That's it. So that particular formula at step 1 is not to be used. That you are not to estimate the spot rate now. The spot rate estimation is not required, right? That's the case. That's the case. So let's have a look at the evaluation method. So same way we have to calculate the payback period method and the NPV, IRR, profitability index, everything. So the first case, it's about the payback period method. So the inflows are given, outflows are given, and we are investing 100 lakh rupees. So what will be the IRR? 30 plus 40, 30 plus 40, 70, 70 plus 50 will be 120. So 30 plus 40 is equal to up to 2 years. It is 70. So it will be 2 plus, and further in the third year, it is 50. So it will be part of 50. And what part left? 30 plus 40, 70, 100 minus 70, 30. So this will be the payback period. So it is 2.6 years. The same that we calculated in the above also, because we are using the same figures. So it is coming all same. Payback period is all same, right? The second one is the NPV method, the algebraic sum method. So here also we have to calculate the risk adjusted rate in the foreign currency. That is to be done. This step would be common for all, right? We have to adjust the risk adjusted rate for the foreign currency. Okay. And once we are done with it, once we have done it, and at that particular point, when we have already calculated it, we can be using the method. First of all, we'll be doing what? Like we'll be using the method. We will be using the same formula in the home currency. In the home currency, let's say you are provided with the risk adjusted rate of the home currency. You are provided with the risk free rate of the home currency, right? Then we'll be calculating the RP first of all. Like we have already done that in the previous lecture. Okay, I have already conveyed the idea to you. So how we are to do? Like let's say you are provided with the risk adjusted rate of the home currency. You are provided with the risk free rate of the home currency. Now using the same formula, we will be calculating the RP first of all. RP will be done. Risk premium will be calculated. And once you have calculated the RP, and then you will be having the RF for the foreign currency also, then you'll be able to calculate the risk adjusted rate for the foreign currency. Getting it? How to calculate? This is an important step. And once you have calculated it, after that you have to discount it. You have to discount it using this RA for the foreign currency. Let's mark it RA star. So using this RA star for the foreign currency, you will be like discounting the cash flows, and you'll be having the present values in the foreign currency thereafter. Present value of the cash inflows in the foreign currency, right? And the third step would be related to that we have to convert the figure. Like we'll be multiplying it by the spot rate, current spot rate, whatsoever you are having, will be multiplying the present values with the present spot rate, and we'll be having it in home currency then, right? And also the step number 4 is like whatsoever the initial investment is there, that is also to be converted into the home currency by multiplying it to the present spot rate, and that will be done, and we can easily be calculating the PV then. So risk adjusted discount rate applicable in cash USS is calculated to be 8.88%. So this is like given in the question now that you have calculated the RA and it came out to be 8.9%. And now the discounting of the cash inflows is to be done at 8.9%. The discounting will be done. And further, then we'll be able to apply the into the initial investment also. So initial investment is to be done like simply multiplying the initial investment with the spot rate. And here we are to do the part. We are able to calculate it. Here's the NPV. So what steps we did follow? So what steps we did follow? First of all, we calculated the RA star, risk adjusted rate for the foreign currency. We discounted using this the inflows. We discounted these inflows. So the discounting is done and we calculated the present value. So far it's in US, in basically USS. And then we multiplying it with the spot rate and we got the home currency value. For the initial value also, we are simply to multiply with the spot rate. We are getting it in home currency. That's it. And thereafter, easily we can be calculating the NPV. Getting it? That how we did calculation. And then it's about the internal rate of return. The same thing, the same step, RA, like risk adjusted rate, is to be calculated. And further, now the discounting cannot be done because it's not the discount rate that we have calculated. We just calculated the risk adjusted discount rate, right? That will be acceptable to the company, but the discounting is to be done at what? The discounting is to be done after calculating the IRR, because it's a definition of the IRR, that the discount rate at which the NPV turns out to be zero. So we'll be having a IRR equation with us. So like the equation is like 0 is equal to initial investment minus I plus the first cash flow. In our case, it was 30. So 30 divided by 1 plus R raised to power 1 and plus so on, right? So let's say second is 40, 1 plus R raised to power 2 and so on. So you'll be having this particular equations with you, right? And by trial and error method, then you'll be solving the IRR. And then particularly you will be discounting the values. And once basically you have discounted the things, right, then you'll be following it. Okay. And simply in case of IRR, you have to just look that if IRR is greater than the cost of capital, then accept the project, otherwise not. Further after that, it's about the profitability index method, the PI method. The PI method. So we are to calculate the foreign currency risk adjusted discount rate. First step. Second step, we have to discount the foreign currency cash inflows. Like the present value of the inflows will be there in foreign currency. Then we have to convert the foreign currency into the home currency, multiplying it with the spot rate. Will be converting the initial investment into the home currency, multiplying it with the spot rate, and then we'll be calculating the PI. That's basically the simple formula is like present value of cash inflows, present value of cash inflows divided by the initial investment. That's the formula is, right? Getting it clear so far? Okay. So here is a question about it. So it says in the a question of risk adjusted discount rate, applicable cash flows USS is calculated to be 8.89%. So this is the risk adjusted rate that we have calculated it. And using it, we basically discounted the values and we got the present value. Present value came out to be 135.55 lakh. Now we will be multiplying it with the spot rate of 80 and we got the present value of inflow. This is the present value of inflows in home currency 10.884 lakh, and the initial investment in home currency is basically like 80 into 100, that's 8,000 lakhs. So we calculate the profitability index to be this. Okay. Now let's have a look at the impact of the transfer pricing. The impact of transfer pricing. So transfer pricing refer to what? Like the pricing of goods, services, intellectual property. It could be loan, it could be any transaction between the related entities of the same group, which are basically located at the different countries. So let's say we are having an MNC here in India and then one particular branch in USA. So what pricing will be done between these two? That's the transfer pricing. So when they are basically pricing the goods, services, intellectual property, loans, transaction related to these two related entities, these are not unrelated entities. These are the related entities. These are related entities. And when how the transaction will be done, that's basically about it. That's the transfer pricing is. And what are the important points related to transfer pricing? So it's a OECD. It's a OECD, that is the Organization of Economic Cooperation and Development, that basically introduce a transfer pricing. They introduce a transfer pricing rules so as to prevent unfair international trade practices. So that there are no unfair international trade practices. So as to eliminate those, the rules were given by the OECD, and many multinational corporations shifted profits to the countries which are having the low tax rates or tax havens, which we say to be, or minimum taxes or no taxes, and those are known as the tax havens. Many multinational corporations shifted the profits to, like, let's say you are earning the profit here, but you'll be shifting all the profit to this particular country. Like the whole manufacturing is being done over here, but let's say one particular part is being by this country and you're transferring the profit to this particular country. That's basically what, like here in that particular country, there is zero tax or there is no tax, right? So that's basically said to be what? That's said to be tax havens, the where the tax is very low. Okay, so tax havens are the countries or the jurisdictions which are having very low tax or no tax and very high financial secrecy. So what are the basic purpose or objectives of these rules? First one, like these rules are applicable to all international transactions. These are applicable to all the international transactions. And the second thing it's related to, so as to avoid the tax evasion, so that the manipulation of the rates cannot be done. So as to avoid the manipulation of rates that is to be done, and so as to ensure the fair taxation, so that there is fair taxation, like the tax profits where actually they have been earned, right? So that's also part of it. So basically, we want the taxation to be done in the country where those are earned, right? And also so as to maintain the arm's length principle. Also so as to maintain the arm's length principle. Now, what is arm's length principle? Now, let's say when there are two related entities which are going to deal with each other, A1 and A2, they are going to deal with each other, right? So transactions which are occurring between these two related entities, right? That should be occurring at a price that is basically normally available between two unrelated independent parties. That's the arm's length principle. That's the arm's length principle. Okay. So that would be the part related to it. I hope that you must have understood the concept so far. And today that would be only that will be covering in this video, and the rest will be covering in the next video. If you want to get the complete PDF, if you want to get the complete course of the CAIIB, simply just do WhatsApp me writing CAIIB. So you need to write WhatsApp and you need to WhatsApp it to the number 83609444207. If you really like my videos, do like them. It really motivates me so as to bring much more content for you. And do not forget to share these videos also, right? And the complete course is available on our application website, so you can be downloading our application. We'll be getting the free tests also. The mega tests are also available. Here is a link, iibf.info/app, through which you can be downloading the application, and it's available for Android as well as for iOS, right? For iOS devices, you have to enter the org code, which is GEGKT. So that will be all. Thank you so much and see you again in the next video.